Hi, everyone. Welcome. My name is Amy Lewis, and I have the privilege of working with hospice and community care. And I just want to say thank you all so much for joining us for today's program, which is what is the Secure Act and how does it affect your retirement? Today will be presented by Adam Saubel. A few housekeeping items before we get started. Everyone will be muted throughout the presentation, but if you have a question, please use the chat button at the bottom of your screen for any questions. Questions can be directed to everyone or just to me, Amy Lewis. Our panelists will be answering all your questions at the end of the presentation. Following the presentation, we will email the PowerPoint slides to you, as well as contact information for Adam. Adam Saubel will be sharing his time and expertise with us today. Adam is a financial advisor with Saubel Financial, a Northwestern mutual wealth management company. Adam is a certified financial planner, chartered financial consultant, chartered life underwriter, retirement income certified professional, chartered special needs consultant, chartered advisor in philanthropy, and he has a certification for long-term care. Adam holds an undergraduate degree from Elizabethtown College. Adam's actively involved in the community through a wide range of organizations, including here at Hospice and Community Care as a member of our Planned Giving Council. Please join me in thanking Adam for his time as I turn the program over to him.
Hi, everyone. So nice to meet you. I do appreciate the opportunity to be here with all of you today. I do want to give a quick shout out prior to us actually getting into this. I know typically I'm meeting clients through referrals and other sources. And, you know, for those that don't know me, my story of why I do what I do for a living is my grandmother right here, actually. She passed away in 2019. She was never fortunate enough to really have a plan, never have professionals, never have anybody in her corner. Also, why she's really important to me is because in hospice and community care is because she was actually a recipient of hospice care at the end of her life as well. So I really do appreciate the opportunity to be here with all of you. I would say that this is probably in memory of her. Same thing as to why I chose to do this for a career. So to start today, we'll talk about the Secure Act. I'm not sure if the Secure Act is something that a lot of people have heard of or not by chance. It's one of those things, and we'll kind of get into the overview of it here of how it affects your retirement. And I actually apologize that maybe in the title should have put how it also affects your estate plan. But if we can go to the next slide then. So to get an overview of today and what we'll be talking about with the Secure Act, first thing we'll go over is just a brief overview of what the Act is, what it stands for, and really what it means to your plan. Second thing we'll walk through is just pros and cons. You know, what's the good things about the Act? Maybe what are some of the negative things in the Act that you should maybe consider that modifies your plan? To follow up to that, Section 3, we'll talk about ways to adapt to the Act, how you can modify your plan, whether you're in a pre-retirement phase or if you are actually in your retirement stage at this point of life. The last thing we'll talk about is the importance of organizing your documents and building your professional team to make sure that everything meets your goals and objectives for what you and your family have planned. And then the last thing we'll open up for question and answer at the end of the presentation. So the first thing we want to talk about is the overview of the Secure Act and give you a little bit of a background here. So looking about putting the Act into action and how that actually came into existence. I would say that the Secure Act is probably the first major revision to retirement planning and what we know it as since 2006 from a congressional standpoint. Like I mentioned earlier, it was actually adopted at the end of 2019 with the annual spending bill. It was really going to be something that professionals, nonprofit organizations, our clients were really concerned about and thinking about. But what happened then, as we all know, is March 2020 rolled around, COVID-19 came into play. Obviously, that was top of everybody's mind. And I'm going to say that the Secure Act, rightfully so, probably got swept under the rug then. At that point, but it's still very important now that we're seeing some light at the end of the tunnel with COVID and the CARES Act and some other things that happened in 2020. It's time for us to step back and look at what the Secure Act actually means, you know, for all of you and our clients. When we look at secure, what's that actually mean? Per anything in life, they like to use acronyms. So secure actually stands for setting every community up for retirement enhancement. As I mentioned that, you're probably wondering, okay, well, that sounds pretty good. What do you mean that there's some bad things in it? I don't know if there's necessarily bad things, but like I said, we'll dive in a little bit later as to some of the changes that is going to probably make you have to adapt to your plan. The last thing I put in there is it did pass with a 417 to 3 vote in Congress. So it was pretty widely accepted and a pretty big bipartisan agreement. We can go to the next slide then. So talking about the pros and cons, I always call it the good and the not so good news. The way I view life is that there's always going to be trade-offs, especially when it comes to Congress and, bipartisan things and all that. So looking at the good behind the Secure Act, and we'll actually dive into these a little bit more in depth, but some of the good things of how it actually sets people up for retirement enhancement. The Act actually provides for an encouragement of small businesses to offer retirement plans and their current offerings to employees. We'll talk about how that actually occurs, like I said, in a couple slides. It also allows for contributions past your required minimum distribution age, or RMD, as you see on the slide there. So in the past, RMDs were at age 70 and a half, where the government started to make you start to pull out of your pre-tax retirement accounts. That age is now pushed back to 72. And if you're still earning income, you're actually able to contribute past age 72 as well. So people are able to put money away longer for retirement, which is helpful for retirement security and enhancement. The last thing is that the Act does allow for some new penalty-free distributions from retirement plans. Obviously, as many of us as maybe have encountered, we don't like to pull from retirement accounts if we don't have to, because typically there is a tax penalty involved in that. When looking at the not so good things behind the Act, I'd say there's really only one major thing that is a downside for us, and it's that it ends the stretch IRA distribution rules. This is a major act on how you will consider donating to nonprofit organizations, but it also just shifts how you'll attack your overall retirement plan in general. So looking into a little bit deeper dives into the positives, which I know we just talked about, we can go a little bit more in depth here on the next slide. As I mentioned earlier, employers have a little bit easier access to retirement plans. It's very crucial that employers are setting retirement plans up for their employees, because other than that, pensions don't really exist too much anymore. You have to be in a very rare work organization to be receiving a pension at this point, I would say. So it's crucial that employers are setting up these retirement plans, but sometimes it was pretty prohibitive from a cost and a risk perspective. So Section 101 of the Act actually allows for multiple employers to run their plans jointly. The best example I can give to everybody here on a local level is that there's actually what's called the Manufacturers Association in New York. It's a bunch of businesses, truly manufacturers, that are doing different things, engineering companies, manufacturers, kind of the lifeblood of York County across the river. And the Manufacturers Association, amongst all their companies and their businesses that are in there, they've actually joined together to create one big retirement plan. So what that does is, if somebody's in the Manufacturers Association, but they have a 4 or a 6 or a 10-person company, it probably didn't make sense for them prior to set up a 401k, because they're very costly, they're very expensive to get into, and they're very hard to administer. So it's allowing smaller employers to team up and run plans together, which is then providing retirement access to a lot more employees. The last thing there at the bottom is that simple and SEP IRAs do exist for smaller employers, but why Congress thought that the Secure Act was helpful is that the simple and SEP IRAs haven't really been that well adopted. So they were hoping that the 401k, how that's the most popular plan out there, it's the most common terminology and buzzword that people are hearing. They're hoping that more employers can set up 401k plans together. If we go to the next slide then, it's not just beneficial for the employers, it's also beneficial for us as the employees as well. Like I said, the changes to the contribution and withdrawal rules, or which the withdrawal rules is what I would also reference as required minimum distributions. It used to be that at age 70 and a half, even if you were still working, you could not contribute another penny to a traditional IRA. But now with the Secure Act, if you're earning income, there's no age cap on contributing to IRAs at all. I did want to clarify what earned income versus unearned income is. Earned income there that you'll see on the bullet is that includes wages, salaries, tips, disability benefits, union strike benefits, and self-employment income. What doesn't count as earned income is any interest or dividends from any investment portfolios or bond portfolios you have, any pension or annuity income, Social Security income, unemployment benefits, or alimony and child support. But like I said, it is a positive that if you are still working, if you still want to save for retirement, you are now allowed to extend the amount of time and the amount of money that you're putting into your retirement accounts, which is helpful as we're living longer. The other thing I mentioned earlier too is that the required minimum distribution age is now 72. I'm not sure that the range of the people in the room or how many people are familiar with required minimum distributions, but as I mentioned earlier, most of us now in life, if we're still working, we're funding what I would call pre-tax 401ks. We're putting in money into retirement on a tax deductible basis. It grows without tax, but when we withdraw that money in retirement, we start to pay the income tax. What these RMDs are when, and like I said, it used to be age 70 and a half. Now it's age 72. That's when actually the government comes in and says, hey, I'll use my name for example. Hey, Adam, we've let you grow your money for 10, 20, 30, 40 years tax-free. You saved the taxes up front and you've never paid us a tax dollar up to this point. They're going to start to tell you how much money you have to distribute out of those pre-tax investment accounts, such as your 401ks and your IRAs. So it's nice that you can at least push that to 72, because once they start to force you to spend out of those accounts, you're starting to pull the money out. You're starting to expose yourself to some income tax at that point in retirement. And I know people don't like paying taxes while they're working. I've learned a lot in life that people don't like paying taxes more in retirement. So it's nice that they give us a little bit of a buffer there to continue to push that back. The other thing I mentioned earlier was a little bit about penalty-free withdrawals from retirement plans. The new rule in the Secure Act is that up to $5,000 is allowed for parents when they're within 1 year of their children's birth or an adoption. Reason being is that there could be expensive medical bills. Sometimes there's financial hardships. Congress just wanted to make it a little bit easier for us to access, some of the money we have saved if people really do need it. The nice thing is that it does avoid the 10% early distribution penalty that some people are aware of. So anytime we have 401ks or IRAs or anything like that, and we're pulling out that money before age 59 and a half, there's typically a 10% penalty assessed to that account, where now the Secure Act is going to allow us to access $5,000 for new children without penalty. The other awesome thing there is the bullet at the bottom, where that $5,000 withdrawal, not that you have to pay it back, but you can pay it back into your plan if you want to, which is nice because you're able to basically, quote unquote, reimburse your retirement plan at that point. If we look a little bit into the deeper dive into the negatives of the Secure Act, going to kind of go from an overview standpoint here, and I don't want to sound like a pessimist, or I don't want everybody to get worked up about taxes, because I always tell my clients this, is that we don't know what taxes are going to be 3 years from now, let alone 40 years from now, which is why I just say that you always have to stay nimble in your plan. What I do want to point out to people though is, and many people are aware, is that the US government has been spending at a deficit. What that simply means is that they're just spending more money than what they're bringing in from a tax revenue perspective. Some could say that maybe could happen forever, but I don't know. What's really interesting on this chart here is if you look at 2020, which is the line there with the red dots, we exceeded over $3 trillion of a deficit last year. $3 trillion that the US government printed out, which I think is definitely needed. But if you're looking with a crystal ball in the future, the money has to come from somewhere. I think Congress will continue to find ways to try and recoup some of that money over time. You'll also see this data was pulled from a couple weeks ago, but we're trending towards the same deficit in 2021 as well. So to give a little bit of preview on that, we can go to the next slide. I think we might need to go back one, actually. So you say, okay, how does the Secure Act maybe, yep, there you go, thank you. You say, how does the Secure Act maybe actually affect my retirement and my estate plan? Well, what stayed the same is that if you ever are considering giving any of your assets to any heirs, there's non-designated beneficiaries, which would be estates, trusts, charities. Anytime that you are giving money to any of those types of bodies or entities, they still have to distribute those funds within 5 years of receiving that inheritance or receiving that money. But the big thing that changed and what we're really going to harp on in today's presentation is the fact that what happened with the Secure Act is that it eliminated payments over the beneficiary's life expectancy, which is also known as the stretch IRA, has been eliminated. What changed is that and we're actually going to have a case study example here, so I don't want to give too big of an example, but if my parents were 80 and they passed away and I was 50 and they left me an IRA, I used to be able to take that IRA inheritance and I could spend it from 50 the whole ways out to my life expectancy at say 92 or 95. So I had 40 plus years for me to withdraw that account. The Secure Act now makes it that when somebody receives an inheritance, they have only 10 years to spend down that account. You will see there's a little disclaimer that some beneficiaries do still fall under the stretch IRA rules, which we'll talk about. And then the other thing is that when people are receiving these inheritances, it does potentially create an unforeseen tax burden depending on how you plan to give, which is why it's going to change our retirement plan and our strategy a little bit. So we can go to the next slide. So you say, okay, who's still eligible to withdraw money over their lifetime? Or as you see there in the title above, those that can still stretch the IRA. So a surviving spouse is still able to stretch the IRA over their lifetime. Do not worry, the government does not make you spend all that money in 10 years. The other thing is that if there's a minor child that is inheriting the IRA, a lifetime payout can be used until age of majority, but then they're forced into the 10-year withdrawal. Disabled beneficiaries and chronically ill beneficiaries can also stretch the IRA over their lifetime. That way the account stays there for them. And then the last type of person that can still stretch the IRA over their lifetime is a beneficiary that's not more than 10 years younger than the participant. I use a real life example. My sister's not 84, but if my sister Kelsey is 84 and her brother Adam, AKA me, is 78, let's say that Kelsey had named me as her beneficiary on her IRAs and other accounts. If and when Kelsey passed, since I'm less than 10 years younger than her, I can stretch the IRA and other assets over my life expectancy as well. I wouldn't be held to the 10-year rule at that point. So if we look at ways to adapt and how to plan around some of these, I would call the negative changes here. So what I wanted to do for everybody was to give everybody a little bit of a case study background in case you're like, well, Adam, I understand that there's a change, but how does that really affect me? Or, what does that really mean for my family and I? So a little bit of a case study here. So let's just say that James and Mary are married with one child named Jennifer. And let's just say that Jennifer is married to her husband, John. And James and Mary, so the parents in the situation here, let's just say that they're retired. And then let's say that Jennifer is a physician assistant at Lancaster General Health, and John is a local certified public accountant. And let's say that they're doing very well for themselves, earning $260,000 a year. Completely made up number. If we look at the financial facts, just to give you a little bit of a made up scenario in the background here, James and Mary, so let's say that James has a $600,000 in an IRA. Let's say that Mary has done very well for herself and saved $1 million in an IRA for retirement as well. So combined, James and Mary have $1.6 million going into retirement. Let's say at age 82, then on the bullet below that James passes away. And let's say at that time, Mary was 78. Mary would receive that IRA, which equates to now Mary has $1.6 million in her IRA because she does the spousal rollover. Let's say that Mary doesn't, obviously she can't give the money to James since he passed away. Mary doesn't really have any, no other children or anything like that. So the next person in line per se is that she's going to name Jennifer, her only child, as her beneficiary on her IRA. So Mary was 78. Let's say that Jennifer was 45 at that time. The last thing to wrap up this case. So let's say that Mary passes away at age 90 and that she was pulling $50,000 a year out of her IRA to live, needs some income on top of Social Security and her pension. So she's leaving $1 million behind to Jennifer, and Jennifer's now 57 at the time her mother passes away. We go to the next slide then to look at the math. So I did want to point out that obviously on the right side there, you'll see that Jennifer and John are currently in the 24% federal tax bracket with their $260,000 annual household income. they will be in that 24% marginal bracket until they exceed $329,000 of income that you see there on the chart. So if we go to the next page then, or next slide, if we look at what happens, so we're going to do before and after. So we're going to say, okay, what happens if the scenario happens before the Secure Act was implemented? And then we say, okay, let's look at what's going to happen after the Secure Act was implemented. So before the Secure Act was implemented, if Mary passed away at 90, Jennifer inherited the $1 million IRA at age 57. Jennifer was going to be able to stretch that $1 million IRA over her entire lifetime. So you'll see there in the left column, we have Jennifer's age. In the second column, we have the inherited IRA dollar amount, which if you take Jennifer going from age 57 the whole ways to 92, that comes out to about 35 years. Jennifer is required to distribute $27,000 a year out of the IRA. So what you'll see there is that Jennifer and John were making $260,000 prior, but now their income from age 57 to 67 has jumped to $287,000. Basically the $260,000 that they're earning from their jobs, and then you're adding in the extra $27,000 from her mother's inherited IRA. What's happening is that they're still in the 24% tax bracket. And when I say extra taxes on the right, what I mean by that is since they have to spend an extra $27,000 out of the IRA, at a 24% tax bracket, it comes out to about an extra $6,600 in taxes for them. This scenario winds up working pretty well for Jennifer as well there. If we can go back just very quickly, sorry, is that when they go to retire, let's say that they're not spending as much or they're not living off of as much in retirement as what they did when they were working. So they drop their income to $130,000. You add in the $27,000 from the IRA that's inherited. They actually drop down to the 22% tax bracket. So they're actually have a little bit less of a tax burden from what they inherited then at that point. If we go to the next slide, then we just have to carry this out to 92. So it's a very long process, but that's the benefit prior to the Secure Act is that Jennifer was able to spend this money over her lifetime and pay the taxes slowly. What you'll see there is the total extra taxes from age 57 to 92 that Jennifer paid from inheriting this IRA was $225,000 or $225,555 at that point, which is a decent chunk of change, but that's the cost of inheritance. It's really tough to not give the government a slice of the pie no matter what. If we go to the next slide, then we'll look at the same case study, but we'll give you the example of what happens after the Secure Act. So now when Mary is 90 and Jennifer is 57 and she inherits that IRA at her mother's passing, Jennifer was required to distribute that entire $1 million IRA by age 67, pretty much, because she has only a 10-year window to do that under the new rules. So you'll see there on the left, same thing, we have the age from 57 to 66. You'll see that the inherited IRA, very easy math here. If we have $1 million, we need to spend that $1 million or pull that money out of that account over a 10-year period. Comes out to an average of $100,000 a year. Jennifer and John were earning their $260,000 in wages. You now have to add the $100,000 in distributions from the IRA into their income. So they're now reporting $360,000 of income to the IRS, and they jump from a 24% tax bracket up to the 32% tax bracket. And now Jennifer and John are subject to paying an extra $26,000 a year in taxes over the next 10 years. So at the bottom here, what you'll see is by the stretch IRA being eliminated, Jennifer is now responsible for paying $266,000 in taxes from her mother's inherited IRA. A little disclaimer there at the bottom is, if we can just go back very quickly, I do want to emphasize to everybody, because there'll probably be a question on this. Under the Secure Act, you don't have to equally withdraw the money. I think it makes a lot of sense where people will do that. But if in this case, if Jennifer inherited the $1 million, she could just withdraw all of it in 1 year if she just wanted to be done with it. Now, that probably wouldn't be a really good strategy, because if you pull out $1 million, you're going to push yourself into the highest tax brackets out there. But I did want to verify with everybody that you're not forced to equally withdraw it over the period. You can pick different amounts for different years. All they care about is that you get all of the money out of the account over that 10-year period. You go to the next slide then. So we just go look at a summary of what the impact here was. So after the Secure Act, Jennifer and John were responsible for paying that $266,720 in taxes from the inherited IRA. Before the Secure Act, when they were able to stretch that IRA over their lifetime, they were only paying $225,555 in taxes. So if we look at what the total negative impact was from the Secure Act, it comes out to about an extra $41,000 in taxes. And I know some people are saying, well, I don't plan on leaving $1 million, or I don't know if I plan on leaving anything. The $1 million was just a scenario. It's all scalable. So if somebody looks at leaving $100,000 behind to maybe, children or charity or something like that, this could actually be maybe an extra $4,000 tax bill just because of the changes in the Secure Act. So it's all scalable. I would say that every dollar matters. It's just good to make people aware of it. That way we can strategize around it. The other thing that I want to point out is not only is it $41,000 more in taxes, but Jennifer and John were forced to pay that over 26 less years. That would be like somebody telling you and coming and saying that you have to have a 10-year mortgage on your house when you would probably prefer to have a 15 or a 30-year mortgage to make the payment a little bit easier. It's much better prior. I know we can't look in the rearview mirror because we're not going to go back to it, but it was much more advantageous to have to pay those taxes over a 35-year period or so as compared to this 10-year window. The 10-year window puts a much bigger crunch on people in their tax planning and their income planning. I do want to point out there are certain variables that can change this scenario easily. There can be federal tax law changes. There can be state income tax changes. Parents can pass away at different times. Beneficiaries can do different jobs. Maybe Jennifer and John aren't a physician assistant and a CPA. Maybe they do different things for livings and they have different incomes and they're in different tax brackets. So this is not a one size fits all. It's not always a negative scenario. I just kind of wanted to build out a scenario where you can see how it can become a negative impact from the Secure Act. We go to the next slide then. So looking at it a little bit, I always talk about this graph here with clients where, and I apologize, it actually got a little bit out of a line here, but it's my goal to provide people with financial security. I think security is a really big word for people. What that means to clients, and you probably all of you on this video conference is probably something different. I classify that as, that you're meeting your goals and objectives. You're able to lay your pillow on your head at night and feel comfortable with what you have in place. We typically tackle that through three main areas of financial planning. The first is the risk management on the left. The second one is the wealth accumulation in the center there. And then the third one is the wealth preservation and distribution. With the Secure Act, we don't really get to focus on risk management too much. The Secure Act is going to focus on our wealth accumulation phase, which is when we're building and when we're accumulating money for retirement. And then at the same time, it's going to impact how we preserve and distribute our retirement dollars, not only from how we live in retirement, but also how we give in retirement if we choose to do so. So we can go to the next slide. If we're talking about being in that wealth accumulation phase, and wealth accumulation is just a really fancy term for, like I said earlier, you're in your 30s, 40s, 50s, you're saving money, you're investing money, you're trying to gain some financial security by building your assets. I would advise people, and this is very generic, everybody's scenario is different, but if you want to say, hey, how can the Secure Act impact me less? It's very important for us to identify a lot of ways to gain post-tax dollars in your wealth building stage. And why that's important is because Jennifer was only exposed to those taxes from her mother's IRA in that case study scenario because her mom was saving it on a pre-tax basis. It was growing tax deferred. But like I said earlier, when you pull that money out, that's when the government starts to tax you on that money. So the way to kind of minimize that Secure Act impact is if we start saving and investing on an after-tax basis, typically when we fund accounts or vehicles on an after-tax basis, the government does not typically come back and tax us on the back end, which kind of mitigates the risk of the Secure Act. So different ways that you can save and invest money on a post-tax basis. You have Roth IRAs and Roth 401ks. There is a chance that not everybody has access to a Roth 401k. they are becoming a little bit more popular and common, but sometimes you only have a pre-tax or a traditional 401k. Roth IRAs are great tools as well. You don't get access to them if you're making more than about $206,000 as a household. But if you're able to access those accounts, it's a great tool to put money on an after-tax basis. You'll never pay taxes ever again on that account. The other thing here is maybe you can't fund a Roth 401k, or maybe you can't fund a Roth IRA. The next thing you could look at is potential Roth conversions of your pre-tax assets. A Roth conversion is just simply enough. If you have pre-tax money, let's say that you had $50,000 in an IRA that you wanted to make post-tax, you can convert that money from pre-tax in the IRA to post-tax in the Roth IRA. What you have to do though is pay the taxes on it upfront at that point. So it might not make sense. A little disclaimer for everybody is the best time, in my opinion, when to do Roth conversions is you want to do Roth conversions when the market is down. Because when the market's down and you're doing those conversions, you're actually paying taxes on less dollars because your investment accounts are basically at a lower value at that point. So a perfect time to be doing Roth conversions was last March, last April, last May, when we saw the market really get hit by obviously the pandemic at that point. The other two other great tools on an after-tax basis, non-qualified brokerage accounts. A non-qualified account is just simply, when I talk about qualified accounts, I'm talking about 401ks, IRAs, Roth IRAs. Those are called qualified accounts because they qualify for special tax advantages. A non-qualified investment account is called a non-qualified account because it doesn't qualify for any special tax advantages. So the money goes in on an after-tax basis. It is exposed to some taxes throughout your lifetime. But if you do actually wind up giving that money away for any inheritance, it actually gets a step up in basis. But it's nice because it gives you more flexibility. You don't have penalties. The government never tells you when to spend the money or how to spend the money. It's a really great place to consider saving and investing a little bit. And then the last piece is just life insurance. I know life insurance is maybe a little bit of a taboo topic for people depending on stage of life. But life insurance is a great after-tax tool because it's very tax favorable in the eyes of the government. The benefits normally pass tax-free as well. So we go to the next slide then. If you say, hey, Adam, I'm already in that stage, I'm already in retirement, I can't fund those accounts, what I have is what I have. How do I maybe optimize this a little bit? When you're in that preservation and distribution stage in retirement, you can look at charitable remainder trust or charitable lead trust. A charitable remainder trust is, just to explain from a very top level, is where you set up a trust where income goes to your beneficiary or beneficiaries, but then the remainder of that trust after a certain time frame or after passing goes to a charity. At the same time, a charitable lead trust is the same concept, but it's actually flipped, where the payments go to charity first throughout your lifetime, and then the remainder of that trust then goes to the beneficiaries. How those tools are helpful is that it mitigates, or potentially it allows for some tax write-offs. The other thing that it's allowing you to do is it's just kind of decreasing your overall state and overall inheritance, and it's allowing you to be philanthropic if you choose to do so. The other thing in the third bullet there is, and kind of mentioned this just on the previous slide, but setting up your retirement and estate plan to where your taxable assets are being spent during your lifetime, or you're giving your taxable assets to nonprofits at passing. So a great way to avoid the whole Secure Act and that 10-year distribution concept is, I'm making up a scenario here, but let's say that you had $100,000 in an IRA, and let's say that you had $100,000 of a life insurance policy. The life insurance policy passes almost tax-free, generally, no matter who you give it to. The $100,000 IRA, if you give that to your children or whatever beneficiary you want to receive your money, that money is going to get taxed and distributed the way we talked about the 10-year distribution rule. So if you had those two and you said, hey, Adam, I want to give some money to charity, but I also want my beneficiaries to have some, I would probably make the general recommendation that you want to try and give the taxable asset. You want to try and give the IRA or some of it to charity, because when the charity receives it, they're a nonprofit. They're not subject to any taxes on it at that point. So you're taking something taxable, you're giving it to an organization that's going to do really awesome things with it, and there's going to be no tax implications from it. And then you can opt to give your, I'm going to say tax favorable or your tax-free assets to your heirs, such as life insurance and things like that. So I put bullet down there of those non-taxable assets. You have life insurance, which is generally tax-free. You have those non-qualified investments or those non-qualified accounts. As I mentioned, those are really nice because you receive a step up in basis. So if you, over your lifetime, let's say that you've put $100,000 into Apple stock. Let's say that Apple stock has grown to $500,000 because they're just the largest company in the world at this point. They're just kicking butt. When you have that account, if you start to distribute on it, you're going to have taxes. But what happens is if and when you give that to any beneficiaries or any heirs, they're actually going to receive a step up in basis. So your cost basis is $100,000 that the IRS cares about, but the minute that you somebody inherits that from you, their basis gets stepped up to the $500,000, and then there's no negative tax implications there. The last piece is those Roth dollars that we talked about. So Roth is always a good thing to hear because Roth is basically an indicator that you already paid Uncle Sam and you never have to pay Uncle Sam ever again at this point. So having Roth dollars really minimizes that Secure Act impact. The one thing is that it would still be subject to the 10-year rule, but it's going to come out tax-free and you're not going to create any negative tax implications there. We go to the next slide. I don't want to get into the weeds of this page, but when talking to my clients and for everybody on this call, the most important thing I could maybe express to everybody is that having choices in retirement really matters. This isn't even just because of the Secure Act. I would just say that this is the way the world works in general. It's always my job or our job as professionals to make sure that everybody has as many different options, or what I would call here as many different buckets to pull from. It's important that all of you are meeting with your professionals and making sure that you have plans in place. Why I talk about these buckets is because on the left side, there's blue buckets. You have your pensions, your social securities, your income annuities. There's a little bit more of your fixed income sources, but you have all these variable accounts on the top there too, with the investment account being those non-qualified accounts. You have your 401ks, Roth IRAs, life insurance, cash in the bank. There's all these different options. And sometimes people get pigeonholed where we think that only one thing or one tool is the best idea. There's a good chance that it might be the best idea. It might be the best tool for you, but we don't get to control what taxes and what happens over the next 5, 10, 20, 30, 40 years. So we always talk about that you want to make sure that you just have as many different buckets as possible, because it's going to give you as many different options when it comes to retirement planning, in wealth preservation and distribution at that point. We go to the next slide then. Key considerations for everybody is that no matter who you decide to work with, not just financial professionals, but your legal professionals, tax professionals, anybody that you're taking advice from in life, make sure you're looking for a quality professional. Make sure you're working with a company that will be there when you need them to be. And the last thing, specifically in the finance world, is work with a financial advisor or representative that you like and trust. I always tell the people I'm working with, it's my job to probably coach and challenge you in life, but I don't want people to feel like they're going to the dentist and getting their teeth pulled. You're going to enjoy working on your plan and reaching your goals and objectives a lot more if you're working with professionals that you enjoy spending time with. So we go to the next page then to dive a little bit deeper into, and to give an overview, you're probably like, okay, how do organizing documents and building your professional team, how does that help with the Secure Act? My point being here, and we'll get into it in some of the slides, is that none of this works if you don't have your goals and objectives hashed out in a will. None of this works if you don't have your documents set up the right way. None of this works if you don't have your beneficiaries designed the way you want them to. So it's super important for all of us to do our checks and balances and to make sure that everything is truly set up the way that you want it to be. First thing I can't stress enough, and no fault on here for anybody if you don't have your will done. Most of us think it's important. By human nature, you hear about a will, most people are like, yeah, I should probably have one of them. And then we think about the attorney bill. We think about the time to do it. We think about death in general is not fun to talk about. I don't like thinking about my death or anybody's death as well, but it's something that is inevitable and we have to face. Yet only 40% of people have a will in place. And I can't emphasize that out of everything we've talked about today, having a will in place is probably the most important document that all of us can have signed and completed in our life. We go to the next page then. If you have kids, the most important thing is making sure you have a guardian in place if they are an extremely young child, if we're past that stage in life. The other thing that's important to revisit is your wills and trusts, your powers of attorney, your healthcare directives, and to make sure, like I said earlier, your beneficiary designations are set up. If you don't, with the Secure Act changes, you have to make sure that those IRAs and those other accounts are going to the right people at the right time, or else you're probably going to create a really negative tax implication, or just not reach the goals and objectives that you have in place for yourself. If you go to the next page then, what we're looking at, and I've kind of stressed this enough now, but you have to review your plan regularly. What we've talked about today is probably going to be different, not only 5 years from now, but probably 2 years from now. So we want to make sure that your plan reflects where you are now in life. Some of you might have these documents completed. You might have thought about this stuff. It's important to always go back and reevaluate at one time what was the way you want it to be, to say, hey, is this still how I want it to be today? So reviewing and updating those wills and trusts, reviewing all those things we talked about, it's super crucial. I can't emphasize enough for you to build a plan, but the plan needs adjusted and modified over time with your goals and objectives. So we go to the next slide then. I throw this in here not because it necessarily has anything to do with the Secure Act, but it does have to do with efficient retirement and estate planning. Wills and trusts are big buzzwords, specifically trust. So I just wanted to clarify what that really means for some people. Both of them are documents that are going to dictate what happens when you're not here with us anymore. And if we go to the next slide, I thought this would be helpful for everybody. It's just a very quick breakdown on what wills versus trusts do, what they do and what they don't do. So the first one there is ensuring assets are transferred according to your wishes. Both a will and trust will get that done. Where a trust is beneficial, and I want to say, some people think that the trust is just for the rich and famous. Some people think that a trust is just to hide from taxes. It might be both of those things, but there's also purposes for every, regular people like us to have trusts as well. The three reasons I would say for that is that it does allow for control of your assets and directives during incapacity and after death, which a will not do. So having a trust in place is not just for, I'm going to say, the rich and famous. The other thing is that you can avoid probate in courts. Probate is that, I'm not going to call it a nasty process, but sometimes an extensive process of settling an estate and going through that whole process. A trust can help administer that. And the last benefit to having a trust in place, no matter how big or small, is that you can ensure privacy. If it's just in your will and you don't have a trust in place, everything, believe it or not, is pretty much public info at that point, which some people might not want. So looking at a summary here, I think it'd be good to leave on that, and we'll get into question and answer. I know I talked a little bit more about the negative side of the Secure Act, but it does have a lot of positive features that are going to help people reach retirement goals. I don't want everybody to think that the acronym, setting every community up for retirement enhancement, I don't want you to think that that wasn't true. I just think that the stretch IRA rule is probably the biggest change in it, and it's a little bit more of a negative change, which you'll see there. The elimination of the stretch IRA causes a major shift in your tax planning, and I put in parentheses there, and tax revenue to the IRS potentially, which I think is going to be continue to be a trend over the next couple of years per the deficit that we talked about. The emphasis in your planning, I think, with the Secure Act is that it's going to be placed on account and tax diversification a little bit more. Go back to that buckets page we looked at briefly, where it's, you want to have as many different options as possible. It's not that pre-tax is better. It's not that post-tax is better. It's not that one account is better than the other. I always tell people that we want to be able to tango with Uncle Sam, and we want to have those choices in your retirement plan. The last thing, and this is a little bit more advanced, the Secure Act, and it might not be applicable to everybody. So I'll throw in that disclaimer here, where establishing a strong foundation for retirement is the first step in the process. I don't want anybody to get worked up about the Secure Act. I don't want anybody to get worked up about leaving money behind to charity or heirs or beneficiaries or anybody like that. The first and most important thing is that you have enough money and a secure retirement for yourself. After that foundation is laid is where you can get into some of the specific nuances about what accounts to use, when to spend them, how to spend them. The most important thing for everybody here on this call is to just make sure we have that strong foundation. The last thing there is that giving might not be important to everybody. you might want to spend all of it. And that if that's your goals and objectives, then you do that. If you want to give, we'll find a way for you to give efficiently, which the Secure Act does change, as we talked about. So you'll see there at the bottom, I put, just make sure that you're meeting with your team of tax, legal, and financial professionals to stay on track and up to date with changes in your plan. What was today might not be the same 5 years from now. It's important to be communicating that along the road and working with these professionals. Having everybody on that team together and having all of them know each other and work together is going to make your life a lot easier for not only you, your family, the charities you want to work with, and so on and so forth. We go to the next slide. We'll kind of leave it for question and answers at that point. And then the next slide is just a thank you with some disclosures I was forced to put in here from our attorneys. So with that, I do appreciate it. We'll open it up for question and answer.
Thank you, Adam. What a comprehensive presentation. We have a lot of questions right now, and I'm just going to ask them in the order that they were received. If somebody else has a question and you're not able to chat, by all means, you can certainly unmute yourself and ask that question. Firstly, Adam, in regards to the Secure Act, I know you don't have a crystal ball, but do you feel like this is more of a temporary legislation and that it will be soon changing? Or do you think that this is really something that's going to be more permanent and long-term?
I think it's permanent. The positive side of the Secure Act, I mean, in the core, that's why the bill was passed. Because the government needs people to save for retirement. We need people to be more secure. America needs better financial planning and security when it comes to retirement planning. Mm-hmm. Pension plans, we saw that they didn't work. So we're forced to be in this 401k world. The Secure Act, I know, like I said, I harped on the negative side of it a little bit more, but it was viewed as a positive. Those positives are going to outweigh that negative. It's something that's going to stay here for a while. We could see some potential changes with that stretch IRA rule in the future. The government is always changing IRA rules, estate rules, and things like that. But the overall majority of the Secure Act is here to stay on a permanent basis, I would say.
Now, should you do a Roth conversion if it puts you into a higher tax bracket, or would you recommend not doing that if that would be the case?
It's tough. It depends on your goals and objectives. I'll throw my legal disclaimer out there. The CFP would never want me to make a recommendation for anybody's plan without knowing your whole situation. And also, we do tax planning, but I don't file people's taxes. If a Roth conversion is going to push you into the next tax bracket, you probably are not as keen to go with that strategy. However, doing Roth conversions up until you reach the next tax bracket, that might be an efficient way to attack a Roth conversion. So in that case of Jennifer and John, where I know they weren't the ones with the IRA, but they were earning $260,000 a year. They don't get into the next tax bracket until they reached $329,000. Maybe you do anywhere from a $10,000 to a $60,000 conversion where you're staying in the same tax bracket at that point. If you're going to increase tax bracket, it becomes a deeper question as to whether it's worth it, but I'll err on the side of caution, and it's not as an attractive of an idea at that point.
Thank you. Are there any repercussions, positive or negative, for using your RMD to go to charity rather than if you don't need that income during retirement? Especially if the beneficiary of the retirement plan is a child?
I just want to say that back. So is there any negative to your RMD going towards a charity if the inheritance or the remainder of the IRA is going to a child? Is that what you said?
That's how I'm reading this. Yeah.
No, I'll say no. Reason being is that if you want to be philanthropic and give to charity, that's a great place to put your RMD because it's going to be a tax right. You're not going to be exposed to the taxes then at that point. You're also doing kind of the strategy we were talking about where you're spending down that taxable asset. Not that you don't want to give the money to your child or your children, but you're decreasing that tax burden a little bit for them. So if whoever this is in this scenario, if you really want to be philanthropic and have a little bit of a tax benefit, but you also want to make sure that you leave some form of a legacy to your child or children, you're executing on the right plan there from just a general standpoint. So I think that sounds like a great strategy if that's your goals and objective.
Thanks, Adam. Would an estate get a tax credit if taxable assets are given to a nonprofit?
Would an estate get a tax credit? Speaking very general, maybe somebody is in a different scenario here, but from an estate planning perspective, the allowable exclusion at this point, don't quote me on the number, but it's north of $11 million per person. So in regards to actual estate taxes, for a married couple right now, you have to be north of $22 million for the federal government to even tax your estate at that point. So if you are giving, I think I answered this question correctly, if you are giving X amount of money to somebody, that is falling into that allowable exclusion that the federal government allows you. So I wouldn't call it a tax credit, but it's getting counted towards that allowable amount that the federal government gives us at this point.
Okay. I think you answered in this question earlier, but maybe just a elaboration, I guess, of the explanation. If is there, when you're talking about a traditional versus a Roth IRA product or retirement product, is there a benefit if it's a non-Roth to have the beneficiary be a trust?
If it's a non-Roth, so if it's a traditional IRA, is it beneficial to have a trust named as the beneficiary?
Right. So if the taxes weren't coming out in the beginning process.
It's not, if you're classifying the benefit as from the Secure Act perspective and from a tax perspective, the trust is not going to provide any tax savings or tax benefits on the traditional IRA. The trust is going to be more so, refer to that last slide there, we don't have to go back to it. A trust is going to be better for dictating how you want the assets spent, and it's going to be better at dictating privacy. Like I said earlier, trust is a big buzzword where people think you shove everything in a trust and it saves you a bunch of money from taxes. A trust, they can do that, but in that scenario, the trust isn't going to serve that purpose.
Okay. Instead of a trust, could you have a transfer on death clause on something like a home or collector cars? Would a transfer on death clause accomplish the same objective, avoiding probate?
I am actually going to just be blatantly honest here. That is into the level of estate planning that I have not studied the law. Transfer on death will move the assets to where you want them to go. Whether or not that's actually going to be classified as avoiding probate, I'm actually not going to answer that question. I would be lying to you if I gave you an answer. I can get the answer for whoever wants it afterwards, but I would consult an attorney on that one before I give you an answer. So I do apologize that I am not 100% confident, but that's why I work with attorneys on that one. So I do apologize.
No problem. I'll email that one to you and maybe we can include.
Okay, I can get an answer. I just don't want to, like I said, I don't want to overpromise and underdeliver. So I'm going to leave that one for people, that one.
That's perfect. Thank you. Do you have a RMD schedule of percentages for distributions? And is that something that you could share as part of the follow-up email?
Yeah, we can give people access to an RMD calculator. Okay. That's pretty easy.
Perfect. And did you say a retired person can convert their pre-tax funds to a Roth by simply paying the tax at their retirement income rate?
Yep. Anytime you do a Roth conversion, whether it's before retirement, after retirement, any point in life, a Roth conversion is just where you're taking that pre-tax money. So you saved it from Uncle Sam up front. The government will let you move it to a Roth. All they say is, hey, we just want you to pay the income tax on it. That's the trick to get it from the pre-tax to the post-tax in the Roth. So if you're in retirement, whatever your income tax bracket is, you'll likely do the conversion at that rate. The one caution, and this is probably back to the first or second question we answered, you'll want to consult with your tax professional to make sure that you don't bump yourself into a new tax bracket. Or if you do, I'm not saying that's the end of the world, but you want to make sure it's an optimal outcome for you at that point. But yep, it will go at your retirement tax rate.
Well, those are all the questions that I'm seeing right now in chat, but if anyone on the line does have a question and you'd like to unmute yourself, I think we have about 5 more minutes here. I'm sure Adam would be happy to answer any follow-up to those or any additional questions you might have.
Yeah, I don't see any others in the chat, and if that's okay, obviously everybody can feel free to. We'll get answered. I do apologize to whoever it was that asked the transfer on death question. Like I said, I don't want to give you the wrong answer, but besides that, if anybody has any questions on anything, we're here to help. Like I said, I appreciate the opportunity to meet all of you and walk through that.
Well, thank you so much, Adam, for providing your expertise and your time today. We'll make sure that everybody has access to both the PowerPoint slide that you provided, a recording of today's program, and Adam's contact information, as well as the answers to some of those questions that we needed in a follow-up email to everyone that's in attendance today. Adam, thank you again. We're getting lots of comments saying thank you and what great information that you were delivered. So we really appreciate that. And we appreciate you all being with us this afternoon. Thanks again. And I hope that you each have a wonderful day.